Hi, I'm Nancy Gibbs, director of the Shorenstein Center at Harvard's Kennedy School, and this is Unlocked. Today, we are trying to unlock the mysteries of the federal debt. And so our expert today is Karen Dynan, professor of economic policy here at Harvard with long experience in government service. And Karen, I am so eager to learn from you because I think that debt and deficit are so much in the news, and it is so easy to confuse, misunderstand, misinterpret. So at the most basic level, what is the federal debt? Who do we owe it to? Why does it matter?
Sure. And first of all, it's a pleasure to be here. These are really complicated issues, but they're very important issues. So let's start with federal debt. Federal debt is the total amount of money that the U.S. government owes to investors, reflecting the borrowing it's done over time to cover the gap between its spending and the tax revenues that it brings in. Okay, so that's what debt is.
So that's like in my household, if my salary is $100 and I spend $110, I'm now carrying a debt.
That is correct, but that, to the extent that we're kind of tracking that year on year, that gap, every year's gap would reflect the deficit, and then you accumulate that up over time and you get the debt. So it's like the running total on the nation's tab.
Gotcha.
Yeah.
So how much, if every year we're spending more than we're taking in,
Correct,
then our debt is going up and up and up.
up and up and up. And you asked who holds it, and there are a wide range of parties that hold it, both domestic and international. So the holders include U.S. households, they include banks, they include pension funds, mutual funds, and foreign governments.
And the form that they hold it in, I hear at different times treasury bonds, treasury bills, treasury notes. Are those all the same thing? Are those all different things?
They're all different, and they depend on different factors like the term of the debt. Is it 3 months that you've agreed to lend the government money for, or is it 10 years that you've agreed to lend the money for? But it all amounts to the same thing. It all goes into the debt.
Why are we hearing so much talk now, concern now? I mean, in one sense, I feel like we have had deficit hawks warning about rising deficits every year, debt hawks warning about we're reaching unsustainable levels of debt. And then a year goes by and everything's fine and the world doesn't come crashing down. So why are we now back in a place where I feel like we are hearing a great deal about?
Yeah, so a couple of things. One is just that debt has gotten very high. Both deficits and debt are high.
And so high meaning what?
Yeah, so let me tell you what I mean by that. So under current law, so assuming that all the laws we have in place now prevail going forward, the deficit is about 6% of GDP, the amount that our economy produces in a year. That's a big number by historical standards. It's about double the level that we've seen over the last 50 years, and it's a level that we really don't see outside of times when the government, wars, bad recessions, pandemics, will see debt go up, but not on a sustained basis like that.
So we just went through a pandemic. So during COVID, you saw a big spike in the deficit, but the pandemic is basically past.
Correct.
So why is it not down again?
Because we have continued to spend a lot more than we're taking in taxes. And that leads me to the other reason why we're hearing so much about it. And that's because right now our Congress is considering a big bill that would actually change laws in a way that would make both deficits and debt much bigger than it would otherwise be. So they're primarily extending a set of tax cuts that they put in place in 2017 that are now about to expire. They're paying for some of it by cutting some spending, but a large amount of it will be funded by additional borrowing. So it'll push those deficits up to 7% of GDP. It's going to put debt on a higher track. We'll see something between $3 and $5 trillion of additional debt 10 years out.
And what happens as people watch this and say, I'm not sure how I feel about continuing to just write IOUs or take IOUs from the government and give my money, and people are reluctant to lend us money. What happens then?
Let me just, can I start by saying something kind of good about debt, which is that it's not all bad. Most countries are borrowing, and there are important reasons a country might want to borrow. So, for example, to fight a recession, or to fight a pandemic, or to basically increase the infrastructure our economy depends on over time. So build more highways, invest more in children, and do things like invest in research. So, that's okay as long as we're the track that we're on is sustainable. Because our economy is growing over time, we can sustain more and more debt.
Well, so I'm glad you raised that, because it feels like you can't talk about the debt in a vacuum. That if you are going into debt in order to make those kinds of investments that make your economy much more productive, so down the road you're going to have more revenue coming in that's going to more than help you pay down your debt, that then nothing to worry about? Yeah,
well, so it depends how things play out. So there are very productive investments that will increase GDP over time and help pay for the investments that you've made. As long as interest rates remain low, then you may be in, fine shape, because, the economy is going to be growing and you have debt. You're going to have to make interest payments on those debt, but you can make those payments because the economy is getting larger over time. The problem comes when you get into a situation where it looks like your ability to make those interest payments is not insured. And that's when you have the people who hold our debt, the investors, start to get nervous.
Many of whom are foreign governments.
And many of whom are foreign government, that's correct. About 30% of our debt is held by foreign governments. So that's one scary scenario that people talk about. What if some foreign government basically becomes unhappy with our country and decides to pull out of the market? And, isn't that going to, cause us to have to scramble to find other people to hold our debt? Yeah, people worry about that. People talk about that in the context of China a bunch. China only owns about 3.5% of our debt, and it's actually way down. Yeah, it's actually way down from where it was years ago. So
Japan is still.
Yeah, so I think the bigger issue is just if there is just a broad-based loss of confidence. All of our debt holders basically lose confidence in our nation's ability to manage our finances, and then you get sort of a buyer's strike. They pull back, and you'll see interest rates spike, because to the extent that they're willing to hold our debt, they're going to want more compensation in terms of higher interest rates.
All right, so we haven't talked about interest rates till now, but what's the relationship between these between interest rates and the level of debt that we're
so it's interesting. So there are a couple of things I should note here. So the interest rates are going to determine the amount of our budget that we have to put towards interest costs.
It's like if the federal budget is, we know that we spend a lot on defense, we spend a lot on things like Social Security and Medicaid and Medicare, we spend a lot on other domestic programs, but a big part of what we spend every year is just the fact that we're carrying this much debt that we have to pay interest on. Like,
that's right.
That we could be investing in education or healthcare, but instead, no, we have to be paying that.
So that's one of the reasons people are worried about debt getting higher and higher, because as it gets higher and higher, even if interest rates stay where they are, interest costs are going to go up. That interest bill is going to go up, and that's going to put a squeeze on kind of everything else that we want to spend the government's money on. So that's problem number one. But problem number two is, well, what if interest rates go up from where they are now? So interest rates, just to put it in broad context, are actually a bunch lower than they were several decades ago. And that's actually why, some of those deficit hawks that you talked about earlier kind of got quieter in the late 2010s because interest rates got low and those interest costs went down. Okay, but now interest rates are higher. They're not as high as they were several decades ago, but they are a good bit higher than they were in the late 2010s. And so as those interest rates go up, there's more and more of a squeeze on the budget. Okay, but on top of that, you might get, it's increasingly likely that you'll find our investors start to doubt whether we can manage this interest bill. And then it becomes kind of a bad spiral because people are going to say, well, I don't want to hold that debt unless you pay me more in interest rates. And then interest rates go up further, and the interest costs go up further. And
so if you're in
people
that
become more doubtful, you get into the spiral.
So what kind of intervention would it take at that point to reverse that spiral?
It would take
it's like a lot of bad choices, it sounds like. You can print more
these
money.
are hard choices. So one thing people talk about is, well, you could print more money because we could just use that money to pay our interest bill. Not a good solution. That's going to lead to inflation, and it's just not something that is going to help us out over the longer run. Really, what we're going to have to do is tighten our belts and persuade investors, yes, we can manage this debt. So we're going to make hard choices about raising taxes and cutting spending.
If I'm a small business owner, and I am looking to invest in my business, I'm looking to grow my business, what are the implications for me and my business at watching this happening?
Yeah. So I should say, even in a world where we don't see a crisis, the more debt that's out there, the more interest rates are going to creep up. Because the more of something that's out there, an asset, to get people to hold it, you're going to have to pay more in interest. Okay? But, so that's going to happen. But then, as I said, maybe we'll get into a situation where it spikes. And the thing is, that's going to raise borrowing costs for the U.S. government. But what tends to happen in the economy is that when borrowing costs for the U.S. government go up, all interest rates go up. So that's a big deal if you're a small business, because you're probably going to need to borrow money at prevailing interest rates, both to kind of fund gaps between your revenues and spending over time, but to grow your business. So this really could hurt small businesses or businesses more broadly pretty badly. And it'll hurt households as well, right? I mean, mortgage costs will go up. People who want to finance an education are going to have to pay more in interest costs. So the whole economy will feel it.
So given all of those harms to businesses, large and small, to individual households, to the ability of the federal government to invest in infrastructure or anything else, there must be a theory of the case for people who are arguing that either it wouldn't matter for Congress to pass legislation that would increase the debt, or that we'll grow our way out of it. What is the argument that they're making if the potential harms are so obvious?
Yeah. So you see people making different arguments. One of the arguments is that we'll make investments that grow our way out of it. I mean, and the truth is that cutting taxes will have a positive effect on growth. But when the government accountants do their estimates of how this is going to affect deficits and debt, they take some of that into account. So we know that even with a little extra growth, it's not going to be nearly enough. Okay, so we can't grow our way out of it. I think, the other thing is that debt has increased a bunch in this country over the last since the early 2000s. And if you told someone sitting in the early 2000s that debt would get as high as 100% of GDP, which is where we are now, they would have said, wow, I assume that the country at that point will face some huge crisis, and we haven't faced a crisis. And so I think that's led a lot of people to to inappropriately conclude that there is no level of debt that basically causes a problem. But that's not right. I mean, the issue here is that there are a lot of complicated factors that go into whether debt is sustainable or not. And one of the big things that's happened since the early 2000s is that interest rates have dropped, so interest costs have gone down, and that's meant that we can sustain a level of debt of 100% of GDP without a crisis.
In the ongoing coverage and discussion of this spending bill or of the federal government's debt levels generally, are there things that you see people consistently getting wrong or misunderstanding that you wish people understood?
Yeah. I mean, and to be fair, it's a complicated topic. But yeah, I think there is scope for better coverage of the issue. I think one thing that I'll see is, a news headline just cite an eye-popping number associated with a piece of legislation that's going through Congress, like the one that's going through there now. There'll be some eye-popping number about how much, more spending is going to be associated with this bill, or how much taxes are being cut, and it's in trillions of dollars. And first of all, a lot of times it isn't even cited correctly. You have to specify, well, if you're talking about the effect on debt, is it just, where we'll be next year, or is it where we'll be 10 years out, or what? Okay, so you got to cite it right. But even then, I don't think these numbers mean a lot to people. You have to put them in some sort of context. So as an economist, I would maybe start by comparing it to the size of the whole economy. Even that, I think, maybe doesn't resonate with your average person. So I think what you really need to do is you need to cover it in a way that people can understand. So if we, cut taxes, consistent with this bill that's going through Congress, what's the impact going to be on the tax bill of people in the top 10% of the income distribution, middle-class families, people in the lower part of the distribution. So that's one thing you could talk about. Part of the way they're paying for this bill that's going through Congress is they're going to make cuts in spending, in particular the Medicaid program, which provides health insurance to poor families. So again, that gets expressed in how many billions or trillions of dollars, but what you really want to say is, if we make these cuts, here's how many million families will lose their health insurance coverage, and here's how many additional deaths, premature deaths, we'll see because of those cuts. So I think it's just really important to kind of put it in ways that resonate with people.
So, there have been people for years who have been saying government has gotten too big, spending has gone up inexorably. We need a smaller, more efficient government. We need to return money to states, to communities, to individuals. Is running up a huge debt a forcing mechanism to force hard cuts in government?
So a couple of things there. And one is that really the spending, we don't have a spending problem. I'm not saying there's no waste in government. There is waste in government. But if you pick apart spending, first of all, you'll see that a bunch of it is on what we call entitlement programs. These are programs, for example, like Social Security and Medicare, that provide really important income replacement and health care for older adults. And that's not something that you can cut without quite likely inflicting some hardship on some families. And it's not something that Americans seem to want to cut at all. These are incredibly popular programs. As for the rest of spending, it's not that high. It's about equal to, where it was in the early 1960s as a fraction
as a proportion
of GDP.
Of the whole economy. It isn't that spending has gone up so much.
It has. I mean, to the extent it's gone up because of these very popular social programs, which gets back to your point about, to fix the problem, having to make really hard choices. So, but you asked, I think your broader question was, if we saw, some sort of smallish debt crisis, would that be a forcing event to get us back on the right track? A lot of people speculate about that. I think it's kind of dangerous thinking. So yes, that's a possibility. We saw this happen in the UK a couple of years ago when there was a budget that looked very likely to create unsustainable debt over time. And we saw the investors who typically buy UK bonds, we saw them pull back. And the UK government was able to turn things around very quickly and basically calm markets down and pull back their intention to kind of manage finances the way they had said they would, and basically things corrected really fast. And so I hear people cite that as an example of, well, if that happened in our country, wouldn't that be kind of great because it would get us on the right track? I think
we don't have a parliamentary system.
Yeah. So first of all, I think people draw parallels when they really shouldn't. It's really a different system. It's much easier with a parliamentary system to make this kind of changes than it would be in our country. But I also just feel like it's kind of playing with fire to count on that.
But the reason I raise it is this what it will take to get Congress to really cut spending? Is that you hear that debate much more than the alternative is to bring in more revenue.
Yeah.
And that the options for bringing in more revenue, which could mean raising taxes, but it could be simplifying a tax code. It could be, actually collecting taxes that are currently legally owed. Like there are a lot of revenue levers, but it feels
beyond raising tax rates. Broaden the base. Right. Yeah.
And yet it feels like we're having a much more robust debate about our appetite for spending cuts and the harms that would come from spending cuts. And there's a missing debate about the other side. You can either spend less money or you can bring in more money if you have a debt problem.
Yeah. There's a lot to unpack there. Tax cuts, never popular with the American people, which is why I think politicians are reluctant to talk about it.
You mean
tax sorry.
Tax cuts, very popular.
Tax increase is never popular with the American people. Most people, which is why politicians don't talk about them, most people don't think the problem is solvable without raising taxes, just if you add up the numbers. And I'll say there that if you go to Washington, D.C. and you walk around from think tank to think tank, there's no end of concrete proposals for how you could get us on a more sustainable track. People say, well, here's, depending on, what we as Americans decide, we want to, how we want taxes and spending to be configured, we could take this option or that option to get us on the right track. The question is really, how do we make this happen? What happens to get Congress to agree to take these steps? And I think that's a question that that needs more study. I mean, there are other countries that have successfully, gotten their government finances on track without a crisis. But I think that's
without really brutal austerity.
Brutal austerity. But I think, we haven't done enough thinking about, what kind of mechanisms would get us there. You mentioned one thing, which was, an event in bond markets. But, is there some sort of, fiscal commission or some sort of move towards a fiscal rule that would get us into the right place? And I think we don't know the answer to that.
Well, one starting point is probably for all of us to understand.
That is absolutely right.
How these dynamics work. So thank you, Karen, for helping unlock the mysteries of the federal debt.
You're welcome. My pleasure.